Hello, and we're back in Module 1, and this time we're looking at Topic 4. And now we're looking at making money grow. So in this topic, we're going to look at something that you'd probably be very interested in as an investor, which is making your money grow. And we're going to look at something that some people tend to refer to as the eighth wonder of the world, and that is compound interest. That is interest on interest. So let's get started. Imagine you had 100 rands 110 years ago, and you invested it. You just stuck it into an investment. You didn't do anything, and any dividends that you earned from that 100 rands you spent and used otherwise. You didn't reinvest. And let's assume a very moderate annual growth rate or annual return rate of 6%. What would that 100 rands be worth 110 years later? Over 60,000 rands. Can you imagine? Now let's look at another scenario where once again you take 100 rands once off. We are going to assume again a 6% annual return rate, and then this time we're going to assume that you reinvest any dividends that you've earned, and we're going to assume a very moderate 3% dividend, constant 3% dividend. If you had invested that 100 rands and reinvested those dividends over 110 years ago, today it would be worth over 1.3 million rands. Quite remarkable. Now let's take it a step further. What would happen if you took 100 rands every single year for 110 years and invested that, and you also reinvested the dividends, and we're going to assume the same growth rates of a constant 3% dividend and a constant 6% annual return? What do you think? Any guesses? 15.8 million rands. So as you can see, compound interest really is the eighth wonder of the world, and it's quite a good incentive to get started investing in shares. But keep in mind the following. When you're looking at shares to buy, ask yourself, how much does the company pay out in dividends? Because obviously, as an investor, you'd like to earn dividends. And then in terms of their dividend payout ratio, how often do they pay out dividends? Is it once a year, twice a year? And then also ask yourself, have the dividends been increasing or decreasing over the years? So generally, investors prefer companies where the dividend tends to increase over time, because they tend to look at a decreasing dividend as a bad signal. And usually what happens is once there's negative sentiment, or a company's share is viewed in a negative light, there's negative sentiment around that share, then what happens? Investors start selling that share, and what happens then subsequent to that? The share price drops. So it's not a good thing. So those are just some things to keep in mind. Keep with the modules. We're going to add on to this knowledge and build more, and get you to a point where you're actually ready to start trading your very first share and experiencing the eighth wonder of the world. And that brings us to the end of Topic 4. Thank you.